Okay, I'll start. Good day to one and all. This is Dr. Sivaramana of IKnowIndices.com. Today we are on 2nd of December. During the European session, all are waiting for the non-farm payroll release. So 13:30 GMT is the time frame for the release of the non-farm payroll data. But before that, at 11 GMT, we are trying to review the market and find out, based on the forecast, in what way the market is expected to move. Then based on the market reading, what could be the possible move in the market? Then based on the trading strategy, we will find out, even if the market goes against, what are the steps we have to take in order to earn money from that of the market. So that we will combine the forecast with that of the market reading as a fine-tuning process. Then finally use the trading strategy to meet the unexpected. As a result, we will find that we will be destined to make profit from that of the market moves. So basically we need to understand that the data released during that of the month beginning time invariably will bring in more volatile moves when compared to that of the data which are released during that of the mid-months. Because during the month beginning and the month end time, the players do the monthly trend reversal moves. Such monthly trend reversal moves are expected to be very highly volatile. But during that of the mid-month, they will try to make use of the data release and try to make some big spikes, either on the upside or on the downside after prolonged consolidation. So the data which is going to be released during that of the trend reversal time, the monthly trend reversal time, will bring in volatile moves in the market. Whereas the data which are going to be released during that of the mid-month, they will bring in the market the spikes. So what is the difference between the spikes and the volatile move? The volatile move, they quickly gain the level and quickly drop and again quickly gain. So as a result, you will find they will try to make an upward stop and above that of the high, and downward stop and below that of the low, and widen the spread. And nothing significant happens to that of the currency other than that of the big moves happening in the market. So we are on 2nd, that is the first week of the new month of December. Besides, it is the month of December and the month of January. The players make the yearly trend reversal moves. So during that of the yearly trend reversal, they will bring in more volatile moves in the market, or we can simply call it as a whipsaw moves. And such whipsaw moves could be used for effective trading, provided we aim to do swing trades without any bullish or the bearish feel. If we become bullish, then we don't mind making a buy after the rise. If we become bearish, we don't mind making a sell after the drop. Then we will get trapped. But whenever they make a very quick rise, we know that they are gaining the levels as a false move in order to offload their buy positions which are taken at the lower level. So we also try to sell along with them when they make a quick upward spike. Then afterwards, they continue to slide and then make a quick drop in order to induce the long holders who are taken the buy positions from them during that of the rise, and they induce them to liquidate the long positions after that of the drop. Then who buys? The players buy back against their higher level sells. So the players make wise trades during such of the prime data release, quickly gain and offload their positions, quickly drop and buy back their positions. So this is what they do in the market. So we need to understand that the players are not fools and they are focused on their money making. But they make others fool by telling the trend is your friend. Follow the trend in the market, follow the fundamentals, follow the technicals. So they just induce all the traders to follow such things which are conventionally very good. When the markets were not operated, all the fundamentals and the technicals are expected to give us the true clues of the market. But when the market is being manipulated, they pretend as if it is following the technical and reverse the market in the name of fundamentals, or pretend as if the market is going to follow the technicals or follow the fundamentals and reverse telling some technical story. So when they are here to trap the traders and earn money, there is no point in studying the conventional type. Instead, we need to read the intentions of the players, what they intend to do in the market. Then accordingly, we should plan our trades. We can only trade along with them. We cannot trade against them because they have got a huge money power and they create the bullish feel and try to gain the levels very quickly. At that time, they offload their buy positions. So we need to understand that. How to find out what is the peak so that when we stop, we are not being trapped vulnerably. For that, we need to identify the type of moves they do it in the market. So I every month explain the type of moves and also how to read the intentions of the player during that of the tracking the forex market together webinar. So next week I'll be giving such a webinar and probably you can attend and understand how that type of moves are to be identified in the market. Thereby we'll be able to read the intentions of the players at any given time. Now we'll focus on that of the non-farm payroll data release and the relative market condition. Now if you look into that of euro, which is around 1.0649, closer to that of the low, 1.0636. And during that of the European session, they just quickly gained the levels. From there, they made the slide. And in the case of yen, it is near that of the middle level, neither closer to high nor closer to low. In the case of GBP, it was closer to that of the high 1.2649 and slowly it has come down to the middle level. And in the case of CHF, which is again in the middle level, Canadian dollar is closer to the top. It's in the middle level again. The range is very narrow. And range is very narrow, 32 pips, and it is in the middle. In the market creates the uncertainty which way the market is going to move. So either it is going to make an upward move or a downward move, one need to understand. Now if you look into the of the net changes, you find euro is showing 10 pips negative net change and GBP is showing 14 pips positive net change. So we don't have a clear picture whether USD gaining move is to be made after that of the non-farm payroll or the USD weakening move has to be taken or has to be established. So they are making a contrarian move. Euro is showing USD gaining move. GBP is showing USD weakening. Then in the case of yen, which is again showing negative net change, which is a USD weakening move. So GBP and USD yen are making the USD weakening move, whereas euro and CHF are making USD gaining move. So which is a contrarian move. Then in the coming to that of the commodity pairs, USD CAD is showing negative net change, Australian dollar is showing positive net change as the nominal USD weakening move. So here you come across that commodity pairs show the USD weakening move. Whereas in the case of majors, that USDL and GBP are making the USD weakening move, Euro and CHF are showing the USD gaining move. In what way the market could make a move? So we need to find out. So first of all, we'll look into the forecast. The forecast says that dip and rise during the Japanese session, and then high level swing and then drop during the late European session. The US non-farm payroll data is to be released by 13:30 GMT. That will be the late European session. So the forecast says that there will be a drop in the case of Euro and GBP after that of the data release by 13:30 GMT. Then 14:30 GMT, after 1 hour, slowly swing and firm up moves are expected during the US session. So that is what I have given here. Euro and GBP were expected to make a false firm up before 13:30 GMT, before the data release, and swing and drop during that of the data release. Then make some firming up moves during that of the US session. So these are all the expected moves as per that of the forecast, which I have given it on Monday during my Asian session live market analysis webinar. And probably those who have been tracking my spike trade call webinars, I gave the earlier one on 29th during that of the US GDP data release. At the time, I was telling that Euro and GBP are expected to gain the levels even though the GDP data is going to be positive. That's what the players did. They created the market sentiment using that of the positive GDP data release, and then subsequently they gained the levels in the case of Euro and GBP, which happened to be a surprise for that of the traders. So if we think that if the data is positive to US dollar, the market has to make US dollar gaining move. Or if the data is negative to US dollar, and if you assume that the market has to make the US dollar weakening move and the gaining move based on that of the fundamentals, we might become surprised because the players sometimes follow that of the fundamentals and make the USD gaining or the USD weakening move. On certain other occasions, they simply reverse the market after that of the data and say that the data is being already built in the pricing or it is discounted. On certain other occasions, they have just made the remark that even though the data is USD positive, they simply spike up Euro and GBP, telling that suddenly there is a risk appetite in the market. So basically, you need to understand such moves can be done only by that of the bank terminals. In the bank terminal alone, one can place a high level buy order and rise the market. In our trading platform, we can only place the market order, or you can place a limit order lower than of the market, a buy order, or higher than that of the market level, a sell order. And if you want to take the position at the market, you can only place the live market orders, and you cannot just place a higher level buy order to rise the market upward or lower level sell order to drop the market. And that is possible only with the help of the bank terminal. So the players use such bank terminal facilities and make quick upward or the downward spike. And they know very well that some of the traders don't commit positions because many of the analysts say that you wait for the market to settle. You wait for that certainty to come in the market. The market might appear bullish or bearish before the data release. And after that of the fundamental data, then one could read which way the market is expected to make a move. Then accordingly you can commit position. That is what predominant of the analysts say. But what the players do, they make either way moves. So based on the fundamental data, if it is USD positive, they suddenly drop Euro and GBP, pretend that it is following the fundamental. Then when the traders commit sell positions after the drop, then the players suddenly gain the level by saying some other rumor or some other interpretations, or say that it's already discounted and people are waiting for the interest rate decision and quickly raise their levels. So ultimately, what you expected to be discussed may not be discussed in the televisions, in the media, etc. But instead, in a proactive way, they will be discussing about the next event which is going to take place. So, which will be really giving you a frustrated situation. So, always keep in mind the players are here to create the market sentiment and act against the traders when the traders have committed the positions. So you have to be smart enough. So when we expect the drop to happen in Euro and GBP, and afterwards swing and firm up during that of the US session. So when they make an initial gain around 1325 to 1330 GMT, one can take a sell position. And after the drop, we can take a buy. And still, we need to use the hedge order to limit the risk. Because you know that when the volume is less and when they place the specific order, the order can just drop the market by 100, 150 pips or gain the levels in the market by 100, 150 pips, and which we call it as a spike. And if you ask any trading terminal, they will say during such hours, there will not be any definite fill. Then how come the market is coming down? If we keep a buy limit order, it would not have been filled. But if we keep a sell stop, and the stop would have been filled. So that is how they make the moves in the market during that of the spike time. So keep that in mind. They are all nothing but the tricks they create. The euphoric condition as if non-farm payroll is going to decide about the future of US economy, and that is going to be the ultimatum by which one has to understand whether US economy is going to be in a boom or a doom and things like that. They make all sorts of cries and then subsequently reverse the market and say that they are all being discounted. So keep in mind that the data could give the trigger for the market to come down, Euro and GBP to come down. And in the process, what they are expected to do, initially they could make an upward stop in the case of USDN and then start making a drop and then drop Euro and GBP along with that in order to drop in order to drop the yen crosses. And later on, during the US session, they are expected to drop further USD yen and gain levels in the case of Euro and GBP. So let us see whether such moves are happening. That is my market reading. So let us look into that of the trades which you can try it in a demo trading platform. Now in the case of Euro, they just showed the level 1.0336. They could make another 50 pips lower move or 40 to 50 pips lower move. When they come below the 1.06, watch and see that the new low is not being breached for 30 minutes. And then try to take a buy position. Then afterwards, they are expected to make a sudden reverse in the market, telling some other story, and then gain the levels again. And afterwards, what happened? After gaining the levels during the US session, they are expected to make the slide towards close as a profit booking move, and they simply dump all their buy positions and leave the market. And again next week, they'll make the drop during the week beginning on the downside in the case of Euro and GBP, and then try to accumulate the positions and start gaining the levels in order to give the traders a bullish feel. Then the traders will buy after the gain, and then they simply offload their lower level buys. So this is what they are expected to do. So in line with that, the trade plan could be either way trades. You can take a buy when they are making a downward stop and and you can take a sell when they are making an upward stop and above that of the high. Similarly, in the case of GBP, they could make a downward move quickly as a knee-jerk reaction in order to create the market sentiment. You can just buy at that time and keep the hedge order to limit the risk, and then they are expected to breach the high and go above. At the time, book profit or take sell positions. And Monday, when they make further drop as a weak beginning false move, you can book profit. Then in the case of Australian dollar, they are expected to come closer to the low what they are set and breach it briefly and then start gaining the level. At that time, you can take a buy and then book profit. In the case of yen, they are expected to make an upward stop and above that of 114.19 and trigger the stops on the upside and start making the drop, because all along they've been gaining the levels last week and this week, and now you'll find they will take similar 2 weeks to drop USD yen before making further rise. So keep in mind, USD yen is expected to make either way wide range swings. So that is going to be the type of move. Watch carefully and take positions. If you got any question, you can ask me in the question answer window. Then I'll be willing to answer the questions. Don't give too much importance to that of the data release and also what is going to be the impact in the US economy. You and I can give so many suggestions, so many interpretations, etc. But none of the US agencies are going to take that into consideration in order to handle US economy. We can only talk for ourselves and we can only share the information among us. But ultimately, what is more important is the trading decisions. So such distractions should not become an impediment or a setback for us to make appropriate trading decisions. It might appear that I am ridiculing that. No, I am being a statistics professor. I know that they will work very well in the market, provided the market is not being manipulated. Unfortunately, the players continuously manipulate and trap the traders, and especially during the year end, they are expected to make very massive moves in the market, and thereby they could trap the traders vulnerably if the traders trade without a stop, and you could come across the margin call impact coming to that of such traders. So if you ask the traders who have lost their accounts many occasions, you can just make a statistics and find out that 99% of the accounts were closed during the month end and the month beginning time, or during the year end, year beginning time, during the monthly and the yearly trend reversal time. When they make whipsaw moves, the traders do not know how to handle the positions, even though they have the hedging facility. As a result, you find that when they avoid keeping the hedge order, the margin call is attracted. When they keep the hedge and continue to close the hedge, the margin gets eroded. Then they know very well the traders cannot survive in the market. But we should be able to outsmart the players. There comes our skill set in order to earn money from the other market. For that, we should avoid becoming over trader. So once you avoid over trading, that is, take only one position at a time, and after booking profit only, you will look into another currency or look into another possible trade. So till you are closing the position, you are going to handle it focused on that particular currency. Probably the other currencies you can refer to in order to understand how they are making the moves in the market. But that position, you have to carefully close it with the profit. Simply closing, taking the position, thinking something that market is expected to go up or come down, and the market goes again, simply closing it, or become frustrated, yell at the computer. These things are not going to help you at all in building your equity. So market rewards patience. So develop patience and then try to trade wisely, outsmart the players, reading their intentions. Then you will be able to really help yourself. Otherwise, you will be simply cheating yourself by telling so many stories or attributes about the market to yourself, and that is not going to help you in making money from that other market. Any question, please? There any question? I'm willing to answer those questions. Okay. So please review the calls and try to take, when they are making a downward, stop and try to take a buy. When they are making an upward, stop and try to take a sell, and keep the hedge order to limit the risk and try to book profit during the US session. And keep in mind, these trades can be tried in a demo trading platform. And then subsequently, I'll come by 14:30 GMT and try to show you the outcome of such trades, and also how exactly they made the moves after that of the non-farm payroll, before and after that of the non-farm payroll. I'll explain to you. Then you will be able to understand how the players are having the hidden agenda to act against the traders. But we can read their intentions based on the type of moves they are making in the market. So focus on reading the intentions of the players and try to outsmart them. You will be able to make successfully the profit. Wish you all the best in your spike trades. See you by 14:30 GMT.